You have a great idea. You have a product or service for which the world has been waiting. You've scraped together enough cash to get your idea off the ground. You have a location. You've done your advertising. You just know this is going to work. And 6 months later, you're out of business. Statistics from the Small Business Administration indicate that about half of new businesses fail in the first 5 years. Many new businesses fail, and the reasons are many and varied. In this course, we're going to address some of the primary financial reasons that new businesses don't make it. There are, of course, many non-financial reasons that new businesses struggle. Poor marketing, poor location, poor product quality. We're going to limit this course to the financial reasons for business failure. If you get everything right but the financial side of things, your business is going to struggle. Of course, if you get the financial side of things right and drop the ball with the non-financial aspects of the new business, you'll struggle as well. With this course, we'll stick with the financial aspects of struggling new businesses because that's what we know a little something about. We have identified 5 common reasons that new businesses that struggle seem to face. Of course, this is not an exhaustive list, but these 5 reasons seem to consistently pop up when it comes to new businesses that struggle. Those 5 reasons are insufficient capital, poor cash management, poor record keeping and controls, improper product pricing, and uncontrolled growth. Before we get started, let me first say that several of these reasons for struggling are interrelated. Uncontrolled growth can relate to poor cash management. Poor cash management can relate to poor record keeping, and so on. While these topics can be interrelated, we will address each one separately and then comment on the interrelationships when they are apparent. So, let's get started. Let's begin with the money needed to start a business. Too many new businesses start their business without enough capital. They just don't have enough money in the bank to support them while their cash flows get up to speed. It turns out that the rent has to be paid, the utilities have to be paid, equipment may need to be purchased or rented, the employees have to be paid, inventory has to be purchased. All of your expenses have to be paid while you're waiting for potential customers first to find you and then second to pay you. There's often a lag between when you get paid for providing a good or service and when you have to pay your vendors. And generally that lag is not in your favor. Also, when starting a business, it takes time for your customers to find you and for you to get your sales and marketing efforts up to full speed. During that time, your expenses will continue to need to be paid. It would be nice if all customers would pay immediately. It would also be nice if vendors would wait to be paid until you are paid. Yeah, that would be nice. Many businesses are forced to close before they are able to find out if their business model has a chance to demonstrate that it's sound. They just run out of money. When starting a business, realize that it will take time for cash inflows to start flowing, but the cash outflows start flowing immediately. Make sure that you have access to sufficient capital to allow your new business venture enough time to succeed. So how much cash is enough cash? The answer to that question can only come through a careful budgeting of cash inflows and cash outflows. It is critical that as part of your business plan, you sit down and carefully and realistically map out your expected cash inflows and outflows for at least the first 6 months of your new business. This exercise will allow you to determine any forecasted cash shortage and will allow you enough time to arrange for needed financing, either from partners or from creditors. Knowing well ahead of time that you will need cash allows you to make necessary arrangements for financing. Finding out today that you need cash tomorrow puts you in an unnecessary bind. We will talk a little later in the course about the specifics of cash management, but it is critical up front that you have an understanding that not having enough money to get started can result in a good idea meeting an early demise. Make sure you have sufficient capital or access to sufficient capital before you open the doors to your new business. Again, many new businesses with great business ideas don't make it through the critical first few months. A great idea is not sufficient. You need to ensure that you have access to enough capital to get you through those first few months. By the way, If you plan on going to a bank to ask for financing for your new business, one of the first things they will ask about is your cash forecast. They will want to know what capital you currently have available to you. If you plan on asking friends and family to invest, if they are smart, they will ask about your cash forecast. To obtain capital from others, you need a cash forecast. You might as well prepare one for yourself. The cash forecast will allow you to determine how much capital you will need to get you through those critical first few months. We know you'll need sufficient capital to get your new business through the critical first few months. Let's assume you've made it through those first few months. You will still need to track your cash inflows and outflows to ensure that you have sufficient cash to pay the bills that are surely coming. Whether you are at the start of your business or well into the life cycle of your business, managing cash is critical for the well-being of your business. And cash management does not happen by chance. It is up to you to ensure that your cash is managed. We will do this by preparing a cash forecast or budget. Let's start our discussion of cash management by distinguishing between two types of costs: fixed costs and variable costs. Fixed costs are exactly that. They're fixed. Budgeting for fixed costs is relatively straightforward. The amount is fixed, at least over the short term. Variable costs are costs that vary relative to some activity or cost driver. For a restaurant, for example, costs might vary based on the number of customers. For a shop at the mall, costs may vary based on the number of hours that the shop is opened, labor costs, utility costs, and so forth. Now, there can be a number of cost drivers, or in other words, costs can vary for a number of reasons. It just depends on how complicated you want to get. Adding more drivers makes the arithmetic a little more complex, but the concept is still the same. Now, step one in cash management is to identify all of your fixed and all of your variable costs, all of those costs. It's easy to forget an expense here or an expense there, and before you know it, your cash forecasts are useless. The cash forecast is only as good as the inputs. Next, we'll talk about variable costs. Answering the question, how many customers can we expect, is the hard part. Please don't gloss over this question. Your business will fail or succeed based on the answer to this question. How many customers can you realistically expect? Many costs will vary based on anticipated customer demand. Answering this big question is beyond the scope of this video, but it would involve such things as scoping out your competitors' volume of business, assessing expected population growth in your area, surveying potential customers, and a whole host of things. Your forecast of sales will be critical in helping to prepare your forecast of cash inflows and outflows. We will do some sensitivity analysis with these numbers to determine what might happen to our profits if more or fewer customers show up. Now that we have a reliable forecast of our cost driver, at least as reliable as possible, we can now compute our variable costs. Please note that as our business grows and matures, we will be able to determine a much more reliable estimate on the number of customers we can expect. Let's now turn our attention to the next area where new business owners tend to drop the ball. That is the area of poor record keeping. Most new business owners hate to worry about the record keeping. They would rather worry about customers and sales and innovation and growth and everything other than record keeping. Proper record keeping and internal controls are the blocking and tackling of new businesses. Not very glamorous and not very interesting, but it needs to be done. And it's safe to say that it needs to be done well. You can liken proper record keeping and adequate internal controls to the keeping of statistics in a football game. The person tracking the statistics is not on the field playing the game, but those statistics are very helpful to those who are on the field playing the game. As we discussed in the previous video on cash management, you need to track your inflows and outflows of cash so that you can forecast future cash flows. All we're talking about here is developing a system of tracking your inflows and outflows, your obligations to others, and others' obligations to you. It can be as simple as that. Depending on the size of your business, you can purchase accounting software off the shelf. There are a number of great products that will do the job with minimal training, but it is critical that someone take responsibility for keeping the books. Why is it critical? Well, 3 reasons off the top of my head. First, More accurate information about your business will assist you in running your business better. You will need information about cash inflows and outflows and about who you owe and who owes you. Second, if you ever need external financing, bankers or investors will insist on accurate financial information. They will need that information to assess business risk. You need that same information for that same reason. And third, taxes. Payroll taxes, property taxes, income taxes, the list goes on and on. You need a system that tracks your tax obligations to ensure that you pay the right amounts at the right times. If the government has to come in and do your taxes for you via an audit, remember, they don't work for you. They work for the taxing authorities. They will not be looking out for your best interest. That will not be their job. So, get yourself a system for tracking your inflows and outflows. Get a system that will keep track of who you owe and who owes you. Get yourself a system that will provide you with the information that you will need to better run your business. Now about controls. What are they? Controls are procedures that should be in place to ensure that 1. The information that is being collected in your accounting system is accurate and reliable, thereby helping you to run your business better, and 2. To safeguard your assets and your records. Now, what sort of control should I have on information that I will collect? You will need to answer questions like, how will you document that your cash outflows are legitimate business expenses? You better have proper documentation. If I'm in a business that has inventory for resale, how will I know how much I have on hand? How do I know how many hours my employees have worked? You better have a system for tracking this information. And of course, you will need a system that collects information about your cash inflows and your cash outflows. And you also need to know who you owe and who owes you. We've talked about that. What else? Well, you'll have information that's confidential about employees, pay rates, social security numbers, etc. That all has to be safeguarded. What about customer lists? What about pricing information? As you can imagine, there's a lot of top secret information relating to the inner workings of your business that you don't want getting out. You need to ensure that you have systems that protect your information and ensures that the system producing your information is accurate and reliable. One last thing to mention that is often taken for granted. You will need to safeguard your cash. You will need procedures in place to make sure that cash and checks are quickly and correctly deposited in the bank and that only authorized expenditures are made. This is no fun to talk about, but we tend to assume that those with whom we work are looking out for the best interest of the company. Now, that is often the case, but is also often not the case. Many individuals are looking out for them. You need to make sure that those individuals are never given the opportunity to be exposed to a situation where they might compromise their integrity. That is done by developing a set of controls within your business to ensure that information is collected quickly and correctly, and that procedures are in place to ensure that assets, especially cash, are handled properly. Now remember, we said at the outset that this topic is the no fun part of business. No one likes to talk about paperwork. If you don't talk about and establish a system that collects accurate information in a timely fashion and safeguards your assets, you will have plenty time to talk about that topic later when your business folds up. A good system of record-keeping and controls is what the scientists would call a necessary but not sufficient condition. A good information system will not ensure the success of your business, but a bad information system will certainly contribute to your lack of success. So what can be so hard about pricing a product? Don't you just figure out what your costs are and then add some sort of markup for profit? Oh, that it were that easy. If your price is too high, regardless of your cost, someone in the market will underprice you, assuming that the quality of product or service is similar. In many cases, you will be a price taker, and you will have to manage your costs so that you can earn a profit given a certain price is determined by the market. Now, let me say that again. In most instances, you don't price your product to cover your costs. Instead, you determine if, given a certain market price, your cost structure is such that you can earn a profit. The biggest mistake new business owners make in product pricing is not considering and covering all of their costs when entering a market. Now, it is true that when you are initially trying to penetrate a market, you may be willing to lose a little money to gain market share, but that strategy is not sustainable over time. over the long term, you must cover all of your costs. All of your costs. Now to our last topic, uncontrolled growth. Growth is awesome. Increased market share is good. Sales trending upward is the dream. And unmanaged growth has killed a lot of companies. Growth must be carefully done or it could be fatal to your business. The reason being is that growth often requires cash, and cash is often the one thing that new businesses do not have a lot of. In fact, a lot of new business owners, when faced with the cash flow issues associated with starting a new business, they mistakenly think that the solution to their cash flow problems is to grow faster, not realizing that the fast growth is causing the cash flow problem in the first place. In other words, they hit the gas when they should hit the brake. So how does growth cause cash flow problems? Well, think about it. In a typical business that is selling a product to a customer on credit, that is, the customer will pay in, say, 30 days, you as the business owner need to pay your rent, pay your insurance, pay your employees, pay for the inventory, then sell that inventory and wait for 30 days to collect the cash. To grow faster means you need to buy and pay for more inventory and then sell that inventory and wait for 30 days to collect the cash. The more inventory you have to buy, the more inventory you have to pay for, and then still wait 30 days to collect the cash. Well, let's just have our suppliers wait longer to collect from us until we collect from our customers. Remember this, your suppliers are having the same cash flow issues that you are facing. They would like to receive their cash sooner rather than later. Whether we're talking about an individual, a family, or a large organization, the overall purpose of a budget is to clearly establish a plan so that performance in relation to a goal or the plan can be carefully monitored. Budgeting has a twofold purpose. The first purpose is to allow individuals or companies to develop a plan to meet a specified goal. The second purpose is to allow ongoing comparison between actual results and the plan. Now, the penalty for not budgeting is severe. The list of companies that have failed in recent years as a result of poor planning and execution is getting longer every day. Now, the basic difference between companies that budget and those that don't is that those that budget will spend money how, where, and when they want to. And those that do not budget often feel like they never have enough money to purchase those things that they need. Now, budgeting is critical to the management planning process. There are two basic types of planning. The long-run planning, which includes strategic planning and capital budgeting, and short-run planning, which includes production and process prioritizing and operations budgeting, also known as profit planning. Long-run planning involves making strategic decisions where the effects will extend several years into the future. Long-run strategic planning involves identifying the organization's mission, the goals flowing from that mission, and the strategies and actions that will be taken to accomplish those goals. With strategic planning in place, the company can then plan for the purchase and use of major assets like buildings or equipment to help the company meet its long-range goals. This type of planning is called capital budgeting. Once the organization's strategic decisions are in place, managers are able to focus on operating plans for the immediate month, quarter, and year. This short-run operational planning can be divided into two categories. First, production prioritization. With the capital structure in place, things like land, buildings, and equipment, managers need to determine how to best use those committed resources to maximize profits. Second is operations budgeting. Once the organization has established its production priorities, managers are ready to go to this second category of short-run planning, operations budgeting. Sometimes known as profit plans, operations budgets are used by managers to establish and communicate daily, weekly, and monthly goals for the organization. Budgeting is such an important activity that the top executives of most companies coordinate and participate in the process. Large firms usually establish a budget committee, which may include the vice presidents for sales, production, purchasing, and finance, and the controller or chief financial officer. These executives work to implement the organization's strategy by coordinating the preparation of a detailed budget in their area of responsibility, and then together oversee the integration of a comprehensive master budget for the firm. Two important issues faced by executives in the budgeting process are, first, behavioral considerations. How will the budget affect people? And second, involvement in preparing the budget. Who gets to help? We will discuss these two issues in the video that follows. Research and experience has shown that several behavioral factors determine how successful the budgeting process is going to be. First, the process must have the support of top management. Without a clear indication from top management that the budgeting process is important to the organization, managers will not be motivated to devote the time necessary to formulate an effective and efficient budget. Second, managers and other employees are more motivated to achieve budget goals that they understand and help design. For this process to work, managers must feel that their opinions are respected and given full consideration. In addition, when internal or external circumstances change, all parties involved should discuss the necessary budget adjustments. Generally, the most effective companies are those that involve employees in the decision-making process. However, involving a lot of employees adds significant time and cost to the budgeting process. Third, deviations or variances from the budget must be addressed by managers in a positive and constructive manner. Identifying deviations from the plan is simply a way to focus management's attention on areas needing improvement. Unfortunately, some managers treat these deviations as an opportunity to find fault and assign blame to lower-level managers. The result is usually a loss of motivation, accompanied by such dysfunctional behavior as interdepartmental bickering, defensive attitudes, and overall unethical behavior. One output of upper-level managers using budgets strictly as a punishing tool is budgetary slack in the budget system. That is, a lower-level manager intentionally creating an easy budget target that he or she is certain can be met. Obviously, all these behaviors waste an organization's resource and do not contribute to meeting its strategic and operational goals. A more useful reaction to deviations is to focus on actions that need to be taken. As one CEO stated, quote, "I never made a dime for the company by assessing blame or firing a manager. If I can provide help to a manager to solve a problem, though, we can see the benefit." In administering the budget process, it is extremely important that top management not use the budget as a club or a whipping stick. And again, we see budgeting is as much about the people as it is about the numbers. The numbers help us achieve a goal, but always remember that the numbers themselves, they're not the goal. The top-down approach, sometimes referred to as authoritative budgeting, is when top management prepares a firm-wide operations budget and distributes it to the major segments of the firm, and then hopefully it trickles down to each lower-level segment manager. Its proponents argue that only top management knows the strategic direction of the firm and is aware of all the external factors influencing its operations. Further, since top management involves only a few people who have risen to positions where they no longer have special interests to protect, they are in the best position to efficiently coordinate the competing needs of the segments. Well, that makes some sense. The alternative is the bottom-up approach, also known as participative budgeting. Each division manager in a bottom-up approach prepares a budget request for his or her segment. These requests are combined and reviewed as they move up the organizational hierarchy, with adjustments being made to coordinate the needs and goals of individual units within the overall organization. Proponents of this approach contend that segment managers have the best information on the products or services they provide, the customers they serve, and the technology that is emerging. They are, therefore, in the best position to identify segment needs and to weigh alternative courses of action, and that makes some sense as well. More importantly, managers who have a role in setting segment goals are more motivated to achieve these goals. It's also good training for managers to develop their planning skills in preparation for promotions to positions of greater authority. Naturally, the organization also benefits when its managers are proficient in planning. However, the bottom-up approach is very costly and time-intensive when compared to the top-down approach. Also, in order to achieve personal goals, participants may also engage in political maneuvering that creates budgetary slack or other problems. Because both the top-down and the bottom-up approach are legitimate approaches, most organizations use some combination of the two. The Budget Committee members know the strategic direction of the firm and the important external factors that affect it, so they prepare a set of planning guidelines that are then communicated to lower-level managers. These guidelines include such things as a forecast of key economic variables and their potential impact on the firm, plans for introducing and advertising new products, and some broad sales targets and resource allocations. With these guidelines in mind, lower-level managers then prepare their individual budgets. These budgets are always reviewed to be sure they are consistent with the objectives of other segments and of the company as a whole. As the Budget Committee understands that changes to a manager's budget should be made with great care, any reasons for changes should be substantial and should be discussed with the managers involved. The blending of these two approaches will vary among organizations. A smaller organization with a few management levels will rely more on the top-down approach than will a larger organization. Top management in smaller organizations tends to be more knowledgeable about and more involved in the operating details.
The master budget is the most detailed and most heavily used budget in an organization. This budget is an integrated group of detailed budgets that together constitute the overall operating, investing, and financing plans for a specific time period. The flow of the preparation of the individual budgets within this master budget network works like this. First, the budgeting process should be based on the long-term strategic goals and plans of the company. In fact, if there is no connection between the company's long-term strategic plans and the company's detailed budgets, then the long-term strategic plans are irrelevant. Another, maybe more positive way to say that same thing is that the detailed budgets within the master budget give relevance to the company's long-term strategic goals. Now, in a manufacturing firm, the master budget begins with a forecast of sales. The sales forecast, in connection with the long-term strategic plan, leads to the capital budget, or the plan for the purchase of long-term assets. The label capital expenditures is given to purchases of long-term operating assets such as land, buildings, and equipment. These assets are acquired to be used over the course of several years. There are several financial models used to make capital budgeting decisions. A simple one is called payback period and involves computing how many years it will take to recover the initial investment cost. Net present value, or NPV analysis, involves comparing the cost of the asset with the value of the expected cash inflows after adjusting for the time value of money. The value of a long-term operating asset can disappear instantly if events lower expectations about the future cash inflows that the asset can generate. These computations are very interesting, but unfortunately are beyond the scope of this course. Now, the sales forecast also leads to the short-term operational plans established by top management. Once the sales forecast or sales budget is created, the budgeting team in a manufacturing company splits into two sub-teams. One of the sub-teams will use the sales forecast to determine the detailed plan for production, the production budget. This team will consider the amount and timing of purchases of raw materials, the hiring needs for the production laborers, and the budget for the infrastructure or overhead costs. This collection of production budgets provide a numerical plan for what will happen inside the factory or the production facility. At the same time, using that same sales budget, the other sub-team uses that sales budget to then construct a budget for the activities that occur outside the production facility. So this selling and administrative expense budget involves the numerical plan for the advertising, payments to the sales team, costs of company headquarters, and so forth. The capital budget, production budgets, and selling and administrative expense budget then come together in the construction of additional budgets, the cash budget and the budgeted or pro forma financial statements. Preparation of the cash budget is discussed later in this course. The construction of the pro forma financial statements is unfortunately outside the scope of this course. A formalized budgeting activity forces management to make many important decisions that guide a company towards its goals. Decisions involving scheduling, pricing, borrowing, investing, and cost control. So we'll begin our master budget with perhaps its most important budget component, the sales budget. The sales budget always begins the budgeting process and drives many of the related budgets. For example, how much inventory we make is a function of how much we're going to sell. How much inventory we determine to make then drives how much material we need to purchase, how many workers we need to hire, and so on. Remember, the term master budget is not just one budget, it is a series of budgets that, taken together, comprise what is termed the master budget. The master budget starts with the long-term strategic plan made operational this year with the sales budget for this year. The first step in developing a master budget is to prepare a sales budget. All the other budgets are developed from this sales budget. Projecting accurate sales is very difficult, however, because sales are a function of both uncontrollable external variables, such as customer tastes and economic conditions, and controllable internal variables, such as price, sales effort, and advertising expenditures. Those uncontrollable external factors driving sales include the following. First, there's the business environment, which includes current government policies and law, the status of the economy, demographics, which are characteristics of the population such as age, wealth, family status, and so forth, and the state of technology. Another external factor, customer needs and taste with respect to the product or service being analyzed and other substitute products. Another factor, intensity of the competition and possible barriers to market entry. Barriers that can include technology copyrights, government contracts, reputation, or large sales volumes that provide economies of scale. Another external factor, seasonal cycles, creating abrupt changes in sales demand due to holidays or weather patterns. And finally, external factors such as unexpected events, droughts, hurricanes, earthquakes. Now, analysis of these external variables is accomplished through research and sales forecasting techniques. These techniques may be as simple as having the sales staff ask major customers about their buying plans for the next year, or as sophisticated as statistical market research techniques. Some firms use quantitative forecasting models. These range from simple growth rate trends derived from the past year's sales to complex forecasting models that attempt to measure the influence of many economic and industry variables. Data used to drive these analyses are obtained from a variety of sources. Now, for most organizations, they divide their yearly sales budget into monthly, weekly, or even daily budgets in order to plan production schedules and cash flows more precisely. Now, regardless of whether the budget is on a quarterly or a yearly basis, the concepts are the same. Remember, the sales budget is the most difficult but the most important budget in this entire budgeting process. If you give an accountant an accurate sales forecast, she or he can create a very useful set of budgets for you. But if the sales forecast is inaccurate, even the best accountant in the world can't generate good production budgets, labor budgets, or cash budgets. After the sales budget is completed, the second detailed budget covers the number of units to be produced during the period. 3 factors need to be considered in preparing this production budget. First, the projected sales volume for the period. Second, the desired amount of ending inventory. And third, the amount of inventory already on hand in the beginning inventory. Ending inventory is an important figure because management wants enough units on hand to meet customer demands, but not so many that unnecessary costs will be incurred because of excessive inventory. So let's consider the question, why does a manufacturer want ending inventory? On one side, what if we run out of finished goods? We'll have lost sales, perhaps now and forever. We'll also have lost reputation. But on the other hand, what if we have too many finished goods? We'll have excess resources tied up in inventory. The inventory could get old and obsolete, eventually having to be sold at a loss. The next detailed budget to be prepared is the direct materials budget. This budget helps management schedule purchases from suppliers. Expected changes in materials prices should definitely be included in the budget calculations. Similar to the production budget shown earlier, the materials purchases budget is based on the level of production and on the required level of ending inventories. The materials purchases budget is then adjusted for the beginning inventory expected for each quarter. Like the production budget, the desired level of ending inventory has a big impact on the direct materials budget. If management does not maintain sufficient materials, then the production process could be held up. If inventories are too high, inventory investment and storage costs can get out of control. The fourth budget in the manufacturing section of the master budget is the direct labor budget. The $20 per hour wage rate must include the cost of fringe benefits, such as the cost of sick leave, vacation pay, insurance, and so forth. Also, we need to include the employer's portion of any payroll taxes. Here we get a hint of how important this detailed budgeting process is. For example, what if we are considering paying our laborers a higher effective wage? This budgeting process allows the company to see the implications of that wage increase before implementing the increase. Management must plan so that sufficient, but not excessive, labor is always available. Otherwise, the company is likely to suffer the high cost of frequent hiring, firing, layoffs, and overtime work. Probably even more important than the high cost of employee turnover, however, is the feeling of demoralization among employees that lack of job security can cause. Now, you can also start to see how our cash budget is starting to come together. This is an important aspect of budgeting, both in a business and in your personal finances. If you are casual about cash budgeting, you tend to remember all of the expected cash collections, but you forget some of the necessary cash payments. A disciplined budgeting process helps you to identify all of the budgeted cash payments. So we better keep going. The manufacturing overhead budget includes all production costs other than those for direct materials and direct labor. Because manufacturing overhead is a major element of total manufacturing costs in many organizations, those organizations that are able to effectively plan and control these costs have a significant advantage in the marketplace. In preparing a manufacturing overhead budget, the first step is to estimate the annual variable and fixed manufacturing overhead costs. To keep things simple for our example, we will assume the variable overhead costs are to be allocated on the basis of direct labor hours. That is, those overhead costs increase in proportion to our direct labor costs. This makes sense. More direct labor hours means the need for more electricity, more wear and tear on the equipment, more need for supervisor time, and so forth. Remember that when we were talking about the master budget, I said that once the sales forecast or sales budget is created, the budgeting team in a manufacturing company splits into two sub-teams. One of the sub-teams will use the sales forecast to determine the detailed plan for production, the production budget. This team will consider the amount and timing of purchases of raw materials, the hiring needs for production laborers, and the budget for the infrastructure or overhead costs. This collection of production budgets provides a numerical plan for what will happen inside the factory or the production facility. The other sub-team, at the same time, uses that same sales budget to then construct a budget for the activities that will occur outside the production facility. So this selling and administrative expense budget involves the numerical plan for the advertising, payments to sales teams, costs of company headquarters, and so forth. The selling and administrative expense budget includes planned expenditures for all areas other than production. The cost of supplies used by the office staff, the salaries of the sales manager and the company president, and the depreciation of the administrator's office building, not the production facility, all belong in this category. And because this budget covers several areas, it is usually quite large and may be supported by individual budgets for specific departments within the selling and administrative functions. Similar to our approach with the manufacturing overhead budget, depreciation expense is eliminated from the budgeted selling and administrative expenses to determine the expected quarterly cash payments for those expenses. Although the selling and administrative expense budget illustrated here looks reasonably simple, it is often more complex in actual practice. Rather than classifying these costs based on their functions, salaries, depreciation, and so forth, as seen here, we often see in practice that these budgets are divided into multiple categories that may emphasize how costs are related to important functions in the organization, such as research and development, or R&D, product or service design, marketing, distribution, and customer service. Successful organizations do this in writing, and they do it all the time. Budgeting is a critical and important part of an organization's long-term survival. Remember, running an organization without using a budget is a very exciting exercise. From one day to the next, you have no idea what's coming. Every morning, you wake up to a whole new collection of surprises. That's one way to run an organization. A different way is to spend some time carefully constructing a numerical plan, a budget. Yeah, there'll still be some surprises, but you will have a framework, a plan, a budget within which to adapt to those surprises. There are several similarities in the budgeting process for manufacturing businesses, merchandising companies, and service companies. Basically, the budgeting process involves budgeting or forecasting revenues and the cash that will be generated by those revenues, as well as budgeting expenses and cash that will be paid for those expenses. Managers are always interested in how much revenue and expense they will have during each budgeted period and how much cash and other assets and liabilities they will have at the end of each budgeted period. Because merchandising companies buy products rather than make them, their budgeting process is less complicated than the budgeting done by manufacturing companies. However, the format of the merchandise company's purchases budget would be very similar to the format of the manufacturing company's production budget. By combining expected sales with desired ending inventory and subtracting the beginning inventory expected to be on hand, the merchandise company will arrive at the number of boats to be purchased rather than produced for the period. Now, these labels, manufacturing company and merchandising company, may seem a bit strange, but let me convince you that you already understand the distinction between the two. A good example of a manufacturing company is General Motors. General Motors assembles raw materials, employs skilled auto workers, maintains a large infrastructure of production facilities, machinery, and supervisory staff, and actually makes cars and trucks. GM then sells those manufactured cars and trucks to automobile dealerships. General Motors makes cars and trucks. It's a manufacturing company. In contrast, a merchandising company doesn't make anything. A good example is Walmart. The goods sold by Walmart are all made by other companies: Procter & Gamble, PepsiCo, Kraft Foods, and Campbell Soup. Walmart buys those completed goods, puts them on the shelves, and sells them. Walmart doesn't make anything. Walmart is a merchandising company. The master budgeting process for a merchandising firm is much less complicated than that done for a manufacturing firm. Merchandising companies replace 4 budgets: the production budget, the direct materials budget, the direct labor budget, and the manufacturing overhead budget used by manufacturing firms with a single budget, the purchases budget. The sales budget and the selling and administrative expense budget are similar to those prepared for manufacturing firms, so we won't discuss those budgets again. Each year, service companies are becoming a larger and larger percentage of the businesses in the United States and worldwide. Service companies differ from manufacturing and merchandising companies in that they provide services to customers instead of a product. Some common service businesses are as follows. There are law, accounting, and engineering firms. There are doctors and dentists, hotels and motels, hunting and fishing guide services, automotive, home and appliance repair services, internet providers. So here's a thought question for you. Is McDonald's a service business, a merchandising business, or a manufacturing business? Think for a second. And the answer is that McDonald's has elements of all 3 types of business. McDonald's manufactures the food that you buy, so there's an element of manufacturing. McDonald's provides a service because they prepare the food for you and deliver it in a rapid, ready-to-eat fashion. There's an element of service. McDonald's often sells toys and other items as part of its promotions, so McDonald's doesn't make these toys. Therefore, McDonald's is a merchandising company. Budgeting for service firms is similar to budgeting for manufacturing firms. In fact, you can think of a service company as being the same as a manufacturing company, except that the cost of materials is very low and the focus is on the labor and on the infrastructure support or overhead costs. As was the case with both manufacturing and merchandising companies, the budgeting process for service firms begins with a sales budget. The service firm does not require a production budget. Service firms sell intangible products such as physician appointments, car repairs, room rentals, or monthly internet service that can't be inventoried. Therefore, the sales volume determined in the sales budget is the same as the production budget for that operating period.
The cash budget, which shows expected cash receipts and disbursements during a period, is impacted by all of the preceding budgets in the master budget. A detailed cash budget will point out when a company has excess cash to invest and when it has to borrow funds. This allows a firm to earn maximum interest on excess funds and to avoid the cost of unnecessary borrowing. The cash receipts section of a cash budget summarizes all cash expected to flow into the business during the budget period. Because many companies generally extend credit to their customers, a lot of their sales are originally recorded as accounts receivable. The collection of accounts receivable is a major source of cash, and its timing is an important consideration in preparing a cash budget. Now, in our example, we assume that all customers always pay. Wouldn't that be nice? In truth, some customers never pay, and these uncollectible accounts must be considered when analyzing estimated cash collections from our accounts receivable. Economic factors often play a significant role in the timing of the collection of our accounts receivable. During recessionary periods, customers often drag out their payments much longer than they would in prosperous times, and we'd need to factor that in. So far, the budgets discussed in this topic are static budgets. That is, they are geared to only one level of sales activity. However, as hard as companies try to predict sales volume, these numbers rarely turn out to be exactly as predicted. In fact, as there are unexpected changes in the economy, technology, or competitors, actual sales can turn out to be very different from planned sales. This is a critical issue since sales budgets are the key input in building the rest of the operational budgets. Therefore, the budgets need to be recomputed based on the actual sales activity. This is the process of creating a flexible budget. A flexible budget is much more useful for control and performance evaluation because it is not confined to one level of activity. Flexible budgets are dynamic. That is, they can be tailored to any level of activity within a relevant range. Using a flexible budget, a manager can look at the actual level of activity attained and then determine what the cost should have been for that level of activity.
For a company that sells a product, the company's operating cycle is the amount of time that elapses from when the company buys the inventory until when the company collects the cash from selling that inventory. The length of the operating cycle is the sum of the length of two very different processes. First, how long from when a company buys the inventory until it sells or uses that inventory. Second, how long from when a company makes a sale until the company collects the cash from that sale. Let's talk about that first length of time, which is often called the number of days sales and inventory. Let me illustrate with an example. Nike makes athletic shoes and other sportswear. Nike manufactures these items and then sells them to retail outlets, typically on credit. In terms of the length of Nike's operating cycle, we must first consider how many days elapse from the time that Nike buys raw materials until the time that Nike sells the finished shoes and sportswear to retail outlets. Using data from Nike's financial reports, it can be computed that this is about 80 days. This is called the number of days sales and inventory. We must then determine how long until Nike collects the cash from these sales to retail outlets. On average, this is about 50 days. We call this the average collection period. If you take these two numbers and add them together, 80 days from purchase of raw materials to the sale of the finished goods and sportswear, and then 50 days from the sale to the cash collection, you get 130 days. That's the length of Nike's operating cycle. Again, the operating cycle is the time from the purchase of the raw materials to the collection of the cash from the sale of the finished goods for Nike. That's 130 days. When Nike purchases its raw materials on credit from its suppliers, Nike pays those bills off in about 40 days. So Nike buys raw materials on credit and then pays for those raw materials after about 40 days. But Nike doesn't collect the cash from selling the finished shoes and sportswear until a total of 130 days have passed. This is why companies such as Nike must carefully manage purchases, sales, and cash collections in order to balance out this mismatch between the timing of cash payments and the timing of cash collections. If Nike wishes to manage its operating cash flow, the company has three dials it can turn. First one is the number of days sales and inventory. In a manufacturing company, such as Nike, reducing the number of days sales and inventory involves streamlining the production process to get materials through the process as quickly as possible. The longer it takes to make the shoes after buying the materials, then the longer Nike has to wait until collecting the cash from the sale of the shoes. Second dial, average collection period. If Nike allows its customers, the retail stores, to delay paying for their purchases, that means that Nike must borrow cash in order to pay its own bills while waiting for the customer cash. There is a fine balance here, balancing the desire to collect the cash with the desire to please the customer by not pestering for cash payment too quickly. The third dial is the number of days purchases in accounts payable. Managing operating cash flow sometimes means stretching out the time when you pay your suppliers. Again, this is a balancing act. If you can stretch out this time, which averages 40 days for Nike, then you are preserving your cash to pay for other things. However, you don't want to anger your suppliers by keeping them waiting too long. If we put all the numbers together, it takes Nike 130 days to convert purchased raw materials into operating cash collections. 80 days to make and sell the product, and 50 days to collect the cash. In the meantime, Nike pays for those raw materials in about 40 days. So for 90 days, the difference between 130 days and 40 days, Nike has to use cash from other sources to keep its operation going. Of course, in a steady state, Nike and other companies can use cash collected from prior sales to pay for the materials purchased to make goods for future sales. But in a growing business, where cash payments to make goods for future sales are greater than cash collected from past sales, this operating cycle mismatch can create large operating cash flow shortfalls. Now, to see a different operating cash flow pattern, let's talk about the cash operating cycle at McDonald's. I love the cash flow pattern of McDonald's. From the time that McDonald's buys raw materials, food and packaging, until McDonald's sells the finished product, the food wrapped in the packaging, about 7 days elapse. Cash collection takes about 2 seconds, because even when the customer uses a credit or debit card, McDonald's gets its electronic cash almost instantly. So the length of McDonald's operating cycle is 7 days plus 2 seconds. 7 days from the purchase of the raw materials until the sale, and then 2 more seconds to collect the cash. Now, if McDonald's pays its suppliers under standard credit terms, McDonald's will pay for the food and packaging in about 30 days. So for 23 days, 30 days minus the 7 days and 2 seconds, McDonald's has the cash before needing to pay its own suppliers. This means that with this pattern of operating cash flows, McDonald's or another company with a similar pattern could grow as fast as it wanted, with the operating cycle itself providing all the cash to finance the operating growth. Capital expenditures are purchases of long-term operating assets such as land, buildings, and equipment. These assets are acquired to be used over the course of several years. In the statement of cash flows, we classify the purchase of these assets as investing activities. The value of long-term operating assets stems from the fact that they help companies generate future cash flows. Capital budgeting is the name given to the process whereby decisions are made about acquiring long-term operating assets. There are several financial models used to make capital budgeting decisions. A simple one is called payback period and involves computing how many years it will take to recover the initial investment cost. Net present value, or NPV analysis, involves comparing the cost of the asset with the value of the expected cash inflows after adjusting for the time value of money. The value of a long-term operating asset can disappear instantly if events lower expectations about the future cash flows the asset can generate. These computations are very interesting but are beyond the scope of this course. Capital budgeting decisions, such as the purchase of operating assets or the purchase of another company, are basically cash flow decisions. The company gives up a certain amount of cash flows today, the purchase price, and in the future, operating outlays, in the hope of receiving a greater amount of cash flows in the future as the asset generates revenues and or produces cost savings. To illustrate a simple capital budgeting decision, assume that Yosef Manufacturing makes joysticks and other computer game accessories. Yosef is considering expanding its operations by buying an additional production facility. The cost of the new factory is $100 million. This is an investing activity. Yosef expects to be able to sell the joysticks and other items made in the factory for $80 million per year. At that level of production, the annual cost of operating the factory, the wages, the insurance, the materials, the maintenance, and so forth, is expected to total $65 million. The factory is expected to remain in operation for about 20 years. Should Yosef buy this new factory for $100 million? That's an investing activity decision. To summarize, Yosef must decide whether to pay $100 million for a factory that will generate a net cash inflow of $15 million per year, the $80 million inflow and the $65 million outflow for 20 years. Now, one simple method that can be used to analyze this purchase is called the payback method, or the payback period. The payback period is just the time it takes for the company to recover its original investment, calculated by dividing the original investment cost by the net annual cash inflows received from the investment. In the case of the factory purchase being considered by Yosef Manufacturing, the payback period is 6.67 years, computed as follows. The payback period is the initial investment divided by the annual inflow. That's $100 million divided by $15 million per year. That's 6.67 years. That's how long it takes Yosef to get its money back. One way to use this payback period number is to invest only in assets that pay back within a certain period of time, perhaps within 5 or 6 years. This required payback period might be set differently for different types of assets. In addition, qualitative factors, such as strategic positioning for future expansion and potential positive motivational effects on employees, would influence the decision. The important concept to remember here is that long-term operating assets have value because they are expected to help a company generate cash flows in the future. If events occur to change this expectation concerning those future cash flows, then the value of the asset changes. For example, if consumer demand for computer joysticks dries up, the value of a factory built to produce joysticks can plunge overnight, even though the factory itself is still as productive as it ever was. In addition to analysis of whether a certain investing activity cash investment is a good idea, a manager must also assess the timing of the investment to fit current cash management needs. Some of the questions that need to be addressed are as follows. Is current cash flow from operating activities or through financing activities such as borrowing sufficient to pay for an attractive investing activity this year? If not, should the acquisition of the land, building, or equipment be delayed until next year? It is often efficient to acquire land, buildings, and equipment in amounts a bit larger than you need immediately, knowing that you will grow into them in future years. This can be better than expanding your productive capacity a little bit each year, for example. So are current cash flows sufficient to pay for a large amount of investing activities this year? You see that managing investing cash flow requires you to think about your current operating and financing cash flows. A company's cash is a unifying element that links all aspects of a business: operating, investing, and financing. The two sources of cash from financing activities are borrowing and owner investment. The most desirable sequence of decision-making with respect to cash from financing activities is as follows. Forecast the level of activity, such as the level of sales. Evaluate the amount of cash that will be generated from or consumed by operating activities. After a careful capital budgeting process, determine the amount of cash that will be needed for investing activities. And finally, if financing cash inflows are needed, compare the relative costs of obtaining cash from borrowing and cash from owner investment. As a general statement, the interest rate cost of borrowing money is lower than the cost of giving up ownership of part of the company in exchange for new partner investment or new shareholder investment. The exact decision this year of whether it's best to obtain financing cash inflow from borrowing or from owner investment depends on market conditions this year. Detailed consideration of these decisions is part of the field of finance. An important cash outflow from financing activities is the payment of cash dividends. A key question in the field of corporate finance is, why do companies pay cash dividends? And if I could answer this question, I'd get a Nobel Prize in economics. But what we do observe is the following. Most established companies pay dividends. Companies are reluctant to increase dividends. They want to make sure that they'll be able to permanently sustain any increased level of dividends. Cutting dividends is viewed as very bad news. And finally, dividends seem to be used to give the illusion of stability. If companies can get investors and potential investors to focus on their steady dividends rather than their volatile net income, then the companies look much less risky. It's the illusion of stability. In terms of managing financing cash flows, it is very important for a company to manage its relationships with providers of financing, lenders, current investors, and potential future investors. Reminder, there are two traditional revenue recognition criteria that both must be satisfied before revenue can be recognized. The seller has to do something, the work, and the buyer has to do something, pay, or provide a valid promise to pay. Now, in many, many cases, revenue recognition is not a big issue. The primary example here is so-called cash and carry businesses, such as Walmart, Home Depot, farmers markets, a restaurant. A cash and carry business is one in which the customer visits the business, receives a service or chooses a good, pays cash, and then leaves. From an accounting standpoint, this is a very simple transaction. Now let's think about the biggest cash and carry business in the world, Walmart. In terms of the two traditional revenue recognition criteria, let's examine them. First, the work. Walmart's work is providing the retail location and the goods for the customers to choose. Once the customer has chosen the merchandise that they want, put it in their shopping cart, and taken it outside the store, Walmart's work is done. You can see that in this cash and carry setting, verifying that the work has been done is simple and fairly non-controversial. Now, some of you have just said to yourselves, hey, wait, what if I return something to Walmart? How does that fit in here? No problem. In fact, if you look in Walmart's income statement, you will see that it doesn't say sales. It says net sales. The net means that Walmart has made a subtraction for the amount of sales that have been returned. So the net sales reported by Walmart is the amount of final sales. Walmart's work is done. But still, revenue cannot be recognized unless both criteria are satisfied. The second one, a cash payment or a valid promise of payment. The cash payment questions are not a problem in cash and carry businesses such as Walmart because the customer can't get out of the building without paying cash for the goods. Now, some of you are saying to yourself, well, what about credit card sales? Those aren't cash sales. But from the standpoint of the retailer, such as Walmart, a credit card sale is the functional equivalent of a cash sale. In fact, in its financial reports, Walmart reports that credit card amounts are collected so quickly, just a few days at most, that the credit card amounts that are still in process are reported as cash. So with a cash and carry business, the revenue recognition issues are quite simple. The work is completed at the time of the sale when the goods are provided to the customer to take home. The cash is collected almost immediately because customers are required to pay before they leave the store. Here are the two traditional revenue recognition criteria that must both be satisfied before revenue can be recognized. The seller has to do something, the work, and the buyer has to do something, pay or provide a valid promise to pay. So, is it okay to recognize revenue before the cash is collected? Well, yes, if the buyer has provided a valid promise to pay. Well, this is just an ordinary credit sale. The customer buys now and pays later. So let's talk about credit sales for just a moment. Selling on credit is a marketing technique, providing a service to customers to entice more customers to buy. Companies sell on credit to the extent that the increase in sales justifies the increased bookkeeping, bad debt, and carrying costs associated with credit sales. Here's an example. Almost all of Boeing sales are credit sales. Almost all of McDonald's sales are cash sales. Now, why does Boeing sell on credit, and why doesn't McDonald's sell on credit? Now, remember, for the seller, a credit card sale is the functional equivalent of a cash sale because the credit card company sends the cash to the seller within a couple of days at most. Let's analyze the three costs of selling on credit in order to determine why McDonald's does not sell on credit, but Boeing does. The first cost of selling on credit, bad debts. Once a Big Mac is eaten, McDonald's leverage in the collection process is substantially diminished. They can't get the inventory, the Big Mac, back, and the cost to collect, going around to people's homes to collect, would exceed the cost of the meal. In contrast, for Boeing, the thought that an airline may fail to pay its bill is tempered by the knowledge that Boeing can recover the airplane and sell it to someone else. The second cost of selling on credit, bookkeeping costs. We all know that McDonald's has served billions and billions of people. Imagine the number of monthly statements that would have to be mailed if McDonald's were to sell on credit. The postage cost alone would be huge. In addition, McDonald's would have to maintain a large computer database to track each of the millions of credit customers. Also, if McDonald's were to sell on credit, A credit check would need to be run on each potential credit customer in order to keep the amounts of bad debts at a reasonable level. Because the transaction amounts are so small, this process would be prohibitively expensive. Finally, each McDonald's location would have to hire several new staff people who would do nothing but manage the bookkeeping associated with credit sales. It is entirely possible that the bookkeeping costs associated with a single credit sale would exceed the cost of the meal. In contrast, for a company like Boeing, where each credit transaction totals tens of millions of dollars, the associated bookkeeping cost is really not large enough to worry about. And the third cost of selling on credit, carrying cost. With cash tied up in receivables, McDonald's would have to pay its operating expenses and finance its expansion through increased borrowing, increasing its annual interest expense. Presumably, the managers of Boeing have done an analysis and have concluded that the benefit of selling on credit in terms of attracting more customers exceeds this increased borrowing cost. Now, in summary, credit sales make the most sense for companies like Boeing, where the number of individual accounts is small, the value of each transaction is large, and the recoverability of the inventory reduces the expected cost of bad debts. For all of these same reasons, a business like McDonald's with lots of customer transactions with small dollar values and where the inventory is not recoverable is not a good candidate for credit sales. Walmart is the biggest purchaser on credit in the world. The following companies sell substantial amounts of goods to Walmart, all on credit terms with Walmart agreeing to pay in 30 to 60 days. PepsiCo, with $8 billion of annual credit sales to Walmart. Kraft Foods, with $4.7 billion of annual credit sales to Walmart. Kellogg, $3.1 billion. Smucker's, $2.4 billion. Campbell's Soup, $1.6 billion. And Clorox, $1.5 billion. Now, in terms of the two traditional revenue recognition criteria, the necessary work of these companies is to deliver goods to Walmart. In order to recognize revenue, they must then receive a valid promise of payment from Walmart. And given the financial strength, long history, and valuable reputation of Walmart, these companies are almost certain to eventually collect their cash from Walmart. So Walmart's promise to pay later is indeed a valid promise of payment. And these companies who sell on credit to Walmart recognize revenue from credit sales a month or two before they ever receive the cash from Walmart. Rent-A-Center, on the other hand, does not deal with customers who are as creditworthy as is Walmart. As mentioned earlier, Rent-A-Center states that less than 25% of its customers complete the full term of their agreement, meaning that 75% don't. With such a high likelihood of customers stopping payments on their rental agreements, Rent-A-Center cannot recognize revenue when it delivers furniture or a TV to a customer because Rent-A-Center has not received a valid promise of payment. With a credit sale, the selling company should recognize revenue at the time of the sale, if the seller has determined that it is probable that the buyer will eventually pay for the good or the service. Both of the two traditional revenue recognition criteria must be satisfied before revenue can be recognized. The seller has to do something, the work, and the buyer has to do something, pay or provide a valid promise to pay. So, is it okay to recognize revenue after the cash has been collected, but before the work has been done? No. You have to have the work done. Let's consider two examples: airline tickets and gift cards. First, airline tickets. Everyone who flies on an airplane pays in advance. Thus, between the time that you pay United Airlines for your flight and the time that you actually fly, United cannot recognize the revenue. They haven't done the work yet. They have your cash, but they have not yet done the work. So United must record an obligation to give you a ride on a plane for which you have already paid. United calls this liability, this obligation, advance ticket sales. As of the end of 2014, United reported this obligation to be $3.7 billion. This represents the amount of cash United had collected from you and from me in 2014 for tickets that we would not be using until sometime in 2015. The number suggests that passengers pay United approximately 40 days before flying, on average. Remember, revenue and cash flow are not the same thing. The $3.7 billion represents a cash inflow from operations for United and would be reported in the company's statement of cash flows, but this is not revenue in the income statement because United has not yet done the work. Now let's think about gift cards. Many companies, retailers, restaurants, and so forth, sell gift cards. The business collects the cash now, but will not provide any good or service until the future when the gift card recipient redeems the gift card. So when is the revenue recognized? Well, let's analyze this question in terms of the two traditional revenue recognition criteria. Let's think about the second criterion first. Has the buyer of the gift card provided a valid promise of payment? Well, yes, indeed. The buyer has paid cash, so that condition is satisfied. Now to the first criterion. Has the seller done the work? No, the gift card seller has done nothing except take the buyer's cash. No revenue can be recognized until the buyer or the person to whom the buyer has given the gift card actually uses the card. Walmart reports the following with respect to its revenue recognition practice for the shopping cards that the company sells. Customer purchases of shopping cards are not recognized as revenue until the card is redeemed and the customer purchases merchandise using the shopping card. Now, there is one more interesting little twist here. As many of us know from personal experience, we sometimes forget about these gift cards or shopping cards after we buy them. We might lose the shopping card, so the card is never redeemed. Walmart has our cash, but we will never redeem the card, so Walmart can never do the work. What happens then? Walmart and all other companies that sell gift cards do the following. This is as described in the notes to Walmart's financial statements. Shopping cards in the U.S. do not carry an expiration date. Therefore, customers and members can redeem their shopping cards for merchandise indefinitely. Shopping cards in certain foreign countries where the company does business may have expiration dates. A certain number of shopping cards, both with and without expiration dates, will not be fully redeemed. Management estimates unredeemed shopping cards and recognizes revenue for these amounts over shopping card historical usage periods based on historical redemption rates. So, assume that Walmart sells $1,000 worth of shopping cards. Also assume that, based on historical experience, Walmart estimates that 10% or $100 worth of the shopping cards will never be used. Also, let's assume that historically the cards that are used have been redeemed evenly over, say, a 2-year period on average. What Walmart would then do is recognize $50 of unredeemed card revenue in the first year and $50 of unredeemed card revenue in the second year. Hey, the next time you go to Walmart and see shopping cards for sale, or the next time you fly on an airplane, smile to yourself in the knowledge that you are among the few who understand how the revenue for these transactions is reported. The two traditional revenue recognition criteria are: first, the seller has to do something, the work. Second, the buyer has to do something, pay or provide a valid promise to pay. Both of these criteria must be satisfied before revenue can be recognized. These criteria make sure that a company cannot recognize revenue casually. Something real must happen first. Work must be done, and a valid, verifiable promise of payment must have been received.